And welcome everybody to RWA Boom, Tokenized Assets on Solana. Ino said it very well, tokenized assets are booming. The total tokenized value of RWAs is over $350 billion already, with massive growth projections. By the end of this decade, the RWA value is going to be in the trillions of dollars. And in TradFi, it can take up to 48 hours to settle an asset, while on highly scalable chains like Solana, we're talking about maybe 400 milliseconds. And it's one of the driver and the reasons why there is such a rush to bring real-world assets on-chain. I'm Radodlav Albrecht, I'm the founder and CEO of Bitbond, and we help institutions to tokenize assets on-chain. Over 8,000 smart contracts have already been deployed through our infrastructure, tokenizing assets over $1.3 billion. However, tokenizing is just the first and often the easier step. The harder part comes with topics like secondary market liquidity, compliance, and institutional adoption. And that's exactly what we want to break down for you today with our great panelists who are a combination of TradFi players as well as more closer to DeFi. And so with this, I would like to start. If everybody could introduce yourselves, tell a bit about your background and what's your current focus on RWA. Victor, maybe let's start with you.
Yes, my name is Victor. I'm working for the DekaBank. I think the title is a bit long. So I'm working in the capital markets department, and I'm leading the digital assets transaction side. And there I'm helping issuers, investors, our savings banks to get into digital asset space, working on transactions, and we executed, I think, over 1.2 billion in volume total already on a security base, and I think is quite far, and happy to be here for the invitation.
Great, thank you.
Yeah, so my name is Dolph. Thank you for organizing this amazing event here today. I'm the founder and CEO of Hyphe Markets. What we do with Hyphe is we enable banks and brokers to offer digital asset trading. So if you buy Bitcoin or Solana, for that matter, at a bank or broker in Germany, chances are we're doing the trade with the broker in the background. And our connection to RWAs is that we're now in the process of issuing our first security token and then also trading it with our clients. And that's, I think, quite an exciting time to be in.
Hi everyone, my name is Jonas. I'm Chief of Staff at Midas. We are one of the leading RWA tokenization platforms for composable and on-chain investment products. And we basically run a couple of product strategies where we give investors exposure to stablecoin yield in on-chain markets, DeFi markets, and bringing now more RWA products to market that are, let's say, giving you uncorrelated crypto yield. And to give you some numbers, we have minted around 2 billion in assets so far and paid out 45 million in yield to our investors.
So, hello everyone, my name is Eric. I'm working for LBBW, where I'm responsible for developing business models and new products within digital assets and especially RWA. Yesterday I was asked to tell a fun fact about myself, and I think it is already a fun fact to be stupid enough to try to move a big German federal bank within digital asset space, what I'm at least trying on a daily basis.
Well, let's try hard to bring more assets on chain. And let's open up the discussion. Jonas, I would like to start with you. At Midas, you bring yield on chain. What I would be interested to hear, why is a public chain like Solana the right network for your products? And what I would also be interested to hear is who are actually your clients, the investors that are buying your tokens? Are we talking more about crypto natives that are looking for more predictable, maybe stable yields in their crypto assets? Or is it actually TradFi players that are coming on chain with a more traditional investor background that are buying your products?
Yeah, very important questions. First of all, I spoke to my marketing team before I came here. I got the approval that I can make a small soft announcement here. So we are going to be on Solana. in a few weeks, hopefully. I think someone from the, I have a colleague here from the product team as well, if you want to talk about it. So we are coming to Solana, and why Solana and why Solana now? I mean, we're talking to a lot of market participants, and I will get to it. Who are those market participants today and allocators in these markets? But mainly, if you look at the growth trajectory of RWAs and stablecoins, in particular on Solana, it's like up and right. So I think over the last 18 months, the stablecoin market cap on Solana 3x'd, is now at 15 billion, RWAs at like 2.5 billion or something. And these are really the key metrics for us to look at, because we basically follow where stablecoins are going. Because at the end of the day, if users use stablecoins for payments or whatever the use case is, eventually they're looking for investment opportunities or interest and yield opportunities. So who are the buyers today for our products? I would say we are still very much in a niche. Our go-to-market is really focused on DeFi markets, and in particular DeFi lending markets. So you can basically use our tokenized assets, our so-called M tokens, and you can use them as a collateral in a lending market and borrow stable coins against it. And it's really attractive if the collateral itself has like a yield profile of 5, 6, 7, 8%, and the borrowing rate on this lending market is 2 or 3%. And this really, at the moment, I would say what we see in the markets mostly attracts very sophisticated crypto-native asset managers and capital allocators, and high net worth individuals, or individuals that are mostly like operating in DeFi markets. But I would not say that traditional finance institutions are there yet on the buy side. Of course, we're tokenizing their products on the sell side, but buy side we don't see them yet. And yeah, would love to hear what it takes for them to come into DeFi as well.
Very well. That's a great bridge to the next question that I have, which is for Victor. Victor, you're with Deka, obviously one of the major financial institutions in Germany. And Deka has actually been one of the pioneering institutions, doing very early transactions, for example, on the Electronic Securities Act in Germany, which allowed for a regulatory sound issuance of bearer bonds since 2022, so relatively early, and Deka has been one of the first issuers under that regime. Now, a lot of the activity, or probably most of it, has been done on private chains, mainly the Swired network, which was actually co-initiated by DekaBank. What do you think needs to happen so that a major financial institution like Deka actually brings the RWA assets on a public chain such as Solana? And I think there might even be a connection to what Jonas just said, because there seems to be still a little bit of a disconnect between the great yield products and then the actual ultimate investors behind it.
Yes, yeah, you have to look normally, as Eric says, so we were called by the regulators one of the most conservative banking group in Europe. So it's the savings banks we are in, and when we started 2017 with blockchain, the regulators never heard something about blockchain. So we even started with Corda first, right? So when we come into space, people say Corda looks good to the regulators. And you have to see when the bank starts, it's kind of a journey to it. And so what we have done mostly on the transaction side, you say on a private, because we got our crypto registrar license, which is needed by the Electronic Securities Act. We got this license on the private chain, but we also have done transactions on public chains. But what normally you really need to get financials or banks on it is kind of like a two approach, because right now, even with the Electronic Securities Act and also in Europe with pilot regime, the digital native bond is not equal to the traditional partners, because if you issue a bond without a CSD, it's not ECB eligible. So the issuer has to pay a spread add-on to compensate that. And when the investor buys, he cannot reuse it like you do it in a TradFi space. So this is like kind of where you really need kind of regulatory certainty to get it on the bond. You have to equal playing field for the assets. And also, of course, banking system, ledger system, market infrastructures. They grow so many years. You have to integrate this technology to it. It takes a lot of time to get into it. And then, of course, what you all mentioned, if you're in space, if you're financial, the Basel committee, right? So when they started with the approach, they say, okay, I would treat the asset like a traditional, so with the lack of the ECB eligibility, but if you use it on a public blockchain, you might have a risk add-on on a capital prudent capital requirements. And this is something a bank, normally when we make a transaction, people are always aware of because the regulatory framework is not clear yet. It's still in change, it's still in development on that point. That's why people wouldn't issue so much on it. And now Basel also changed to say maybe we should distinguish, make it more technology neutral. But this is kind of, you have to get from the regulatory framework the assets equal to the traditional bond with all the features that the issuer can scale without paying add-on. And then you say the private and the public blockchains also have the same with add-ons. They are safe because you have all these functions. Then kind of financials are open to onboard, because on the custody side, if you look on the custody side, we also have, we are very open to chains. We are connect, of course, with our retail offering to all main chains where the cryptocurrencies are on that point.
Yeah, very good points, especially on the BIS side. So when equity requirements for the same risk are different only because an asset is settled on a different infrastructure, of course, this makes it quite hard. So yeah, there's definitely some regulatory work to be done, and I also agree on the infrastructure adoption side. These are definitely things that take time. Another topic I want to talk about is liquidity. Dolph, you're with Hyphe, a regulated market maker and liquidity provider. In your view, what needs to happen for RWA assets to actually have the deep liquidity that is needed for them, to be actually meaningful assets? So from your standpoint, what needs to happen, and how can you maybe even help with that?
Yeah, I think one of the misconceptions is that once you tokenize something and put it on chain, that you also make it tradable and suddenly you have liquidity for it. And I think that could not be further from the truth. Because the issue is, like, it doesn't really matter how a security or how an asset is traded, or how it's settled and where you sort of record the transactions. The most important point is, like, sort of, is there interest in buying and selling? And if this product is not interesting, if there's no active secondary market, then it's also very hard to get better liquidity just because you tokenize it. And that's, I think, what we are, or in our position also have been facing and dealing with, because we entered the market some time ago. We're now a regulated securities trading firm. We have a MiCA license. We're trading actively on a day-to-day basis crypto assets, and we want to make that leap and want to say, okay, well, as we don't have an existing securities trading infrastructure, we could think it fresh. We could really start on new rails, not build any legacy infrastructure, and trade the products with our clients on this entirely new rails. And that's also what we're looking for. But we faced the issue that there were not enough interesting products. And unfortunately, I think a lot of the tokenization efforts, the one business model that we're seeing is primary issuance, where you say you take an asset, the asset is worth 100, you then sort of tokenize it, you try to sell everything for 120, and you hope that nobody ever calls you again. That's a business model that works, but that's not the one that we're interested in. What we want to do is we want to actively trade in a secondary market. And that means you need to have a product that's liquid enough for us to offer it for trading and also to hedge it. And that sort of we have found is very scarce. So based on this need, we just decided to fix the problem ourselves, and that's why we will be issuing our first securities and start trading with them with our audience, and make sure that we have active, interesting, liquid products to then trade with our clients.
It's a great approach to trying to solve the chicken and egg problem, right? Because on the one hand, if there are no great assets on chain, then you won't have investors and buyers. But also, who wants to issue great assets if there are no investors and buyers, right? So, making a first step, issuing an asset is definitely something that can help facilitate that process. Eric, to you, also with LBBW, one of the major financial institutions in Germany, LBBW has also been at the forefront of tokenization and digital capital markets very early in some of the major transactions that happened, also partnering with Bitbond to bring crypto assets to the masses, you could say. Looking at tokenization from the standpoint of a commercial bank, what would you say is the biggest ROI that can come from tokenization? Do you look at it rather as a cost case, where you improve margins, improve settlement, make it cheaper all along, and create a higher profit for the bank? Or do you look at it more of as an expansion case, where you can create entirely new products that have not existed before, or maybe package them in a new way, and by that potentially expand your business volume? What is the perspective that you're taking at it?
So, as you're asking that, a passionate business model developer, kind of an obvious answer from me right now. So, for me, it isn't about optimizing processes. So, I'm not into process optimization or cost cutting. I'm more into, as I said before, the crazy stuff. So, for me, it is all about creating new business models, new products, or being able to offer those products to a broader variety of different investor groups within one infrastructure. And that's what blockchain, what tokenization enables us to do. And I think that will unfold upon 3 stages. And stage 1 is what we are actually already witnessing. We are now seeing more and more traditional, well-established asset classes like bonds, certificates, and so on, shifting towards DLT, where all those obvious process optimization things happen, of course. So at the first stage, we make existing products slightly better. Stage 2 then will enable us, or enables us, to slice the same asset into different slices regarding which investor group we are targeting. So we can target different investor groups with the same asset on the basis of the same infrastructure, but without increasing costs, coming through tokenization and blockchain. But that's not enough yet. That's stage 2. Stage 3 is where I am working on a daily basis, and where I'm really passionate about. Stage 3 for me is creating, as you said, Radko, a whole world of new products, new business models, and that's where the most fun is in. But from my point of view, that's also where the most money lies in. So on stage 3, coming through tokenization and blockchain, we are now able to really access or give access to assets not many investors had access to before. So we can now create really performance-linked, KPI-linked products, smart products. We can really create programmable assets, but without the cost issue we would have had dealing with traditional vehicles. So just imagine we can now create products with cash flows being dependent on the underlying assets' real performance. So how much green energy was produced by your underlying asset, or not just produced, but also sold on the market. How many real money was generated through your EV charging infrastructure, things like that. So bottom line, I think the real ROI will not be about cutting costs. Of course, that's nice to have and necessary, but it really is more about more revenues. And more revenues will be gained through new products, but of course the new products are very much dependent on the process optimization that occurs before stage 1 can occur. So yeah, one leads to the other, but the major thing for me and the biggest fun is new products, new business opportunities.
Great. Yeah, expanding revenue is probably for most involved the more exciting case. I still want to come back to one big elephant in the room, which I would coin the compliance clash. I would love to discuss and open the panel for more discussion about what's your view. Will we have a split, as we have it right now, between private chains like Swiat or Canton Network, which over the past months has gained quite some traction, versus public chains like Solana. So is this something that will, continue to exist because financial institutions will need to meet European compliance requirements, and it will be hard for them to get on public chains? Or will these two worlds eventually merge, and will most of the volume arrive on public chains at some point? Who would like to give their opinion, their view on this? Who's interested to start?
I can make a start maybe with one move I want to debunk. So Midas is issuing MiFID instruments, Market in Financial Instrument Directive. It's a European securitization framework that exists for 2 decades, I guess. We are able to issue our products on a public blockchain. So a public blockchain today, and since the longest time, is a valid register for the investor rights and their instruments. So this is something in Europe is definitely not a hindrance. There might be others. Other panelists can maybe speak about. And we actually have a head start here in Europe over the US. And we see this in the market. We have now US companies, Kraken, Ondo, and Robinhood, that issue those MiFID instruments as tokenized stocks in Europe, and they have chosen Europe to do so. So it's a clear indication we have a head start here. We should not blunder it, because the US, as we know, policy changes is definitely keeping up. That's just a comment from my side on this topic.
Great. So you say it's already happening. We have proof it works. Any other views?
Yeah, maybe let's conclude, at least go on with a no-brainer, at least from my point of view. So I think the discussion shouldn't be longer about public versus private, or public or private chain infrastructure, but we should find ways, and I'm certain there are ways, how to combine best of both worlds. Because as commercial banks, and Victor perfectly described it, we have to follow strict regimes, compliance regimes. We are dealing on a daily basis with AML, KYC, finality of ownership, transactions, things like that. So a whole bunch of security measures we have to take, and those naturally come with what banks are building within their closed loops, when we're talking about Swiat, R1, or Onyx, of course. But what they don't have, naturally, is liquidity, is a global reach, is scalability, and that lies within the public chains like Solana, for example. So we should find some ways to add our security layer, our natural given security layer within our closed loops, upon the best from the public chain world. So we should find ways for them to be interoperable and to communicate with each other.
Yes, well, what I also would add, I would say also what Eric says, so don't talk too much about private and public. Let any company of financial start it with a journey, because it's a cultural change also within the company. So it's not like, banking is conservative. They have to start. I like any bank who start any project, even a public or on a private. Let them gain experience. Let the compliance, the IT gain the experience. Then they will understand the technology. What are the fallbacks? They can track the change. They got providers who track the chains and how. Because people sometimes talking about private and public blockchain never made a transaction. It's like, I'm selling you right now a sports program. I don't look like I can sell a good sports program, right? So it's always, if you make a transaction, you make the experience, then you can go to talk. So also innovations normally starts with fragmentation. And it's also in this space, of course, people try, everybody builds a chain, hope to get to be the chosen chain. So let the people get the experience, I would say, even on private or public. So with the custodian service and with the MiCA, you are really open. So the customer normally don't have to deal with any chains, right? They just want the product. So then you have the travel rule, but you still need kind of the journeys and the people who start, because even a bank, they can have their own wallet. So just for customers, they are MiCA. But how many banks in Germany has a wallet and can do tokenization? So start with the wallet first. Everybody's talking about stable coins today and before. Stablecoin issuer can issue on 5-6 chains they can choose. It could be also on the asset side in the future, or you can build bridges if there's a consolidation. So I think the market should be very open and the traditional finance should start and not waiting that the standard is coming and just sitting on a sideline, because what financials also estimate, they are the voice to the regulators, because they are the normal people who are working today in the financial market. And if they seem something has changed, they can talk to the ECB, they can talk to the regulators, they are the natural voice. And if they don't take it and just wait that somebody's making a standard, it will never happen, in my opinion.
Just very quickly, I think for me, I think the issuance will move to public blockchains. That's, I think, what we're seeing, I think what will happen. When it comes to trading and free movement of these coins, I believe that the DeFi world and the regulated world will stay separate for quite some time.
Very interesting views and hypothesis. Yes, I have to say I would lean towards Eric's view. We just need to make it work through technology. It reminds me a bit of the early days of the internet, when people loved to watch video online, but nobody thought that video streaming is ever going to be a thing because the bandwidth just wasn't there. And then, technological progress brought us much more bandwidth, and now the #1 use case online is watching Netflix, YouTube, and other videos. So I think we're going to get there. We're almost at time, unfortunately, so I would love to wrap it up with a rapid-fire question. Everybody, one sentence. Fast forward to 2028. What is going to be the most successful RWA category on public chains?
So structured products. I think there's a huge market for structured products out there, where banks are issuing all kinds of derivatives, certificates, turbo products, options, and all of this is happening daily. And we're seeing that on a structured product base that you do as a tokenized security, you have substantially lower issuing costs, 60 to 70% lower, and you have also substantially cheaper settlement costs for the brokers. So I mean, many of these products get traded once or not at all.
It's more than one sentence,
and
but structured products, it is.
It is structured products.
Still going to be the dollar, if we like it or not. But what is definitely a growing category are tokenized stocks, and that's especially happening on Solana.
Yeah, hopefully, because that's what I'm working on a daily basis. Smart, programmable, mass market ready, and secondary market ready infrastructure projects, cash flows.
Cash flows, okay.
So, yeah, many products I mentioned, so I'm going with the European tokenized money market funds. So, because if you believe in the panel before, the European stablecoin will get relevance, you will need European tokenized money market funds.
Great, so we have the full spectrum. I go with Dolph structured products. That's what we're seeing with Bitbond and high demand category. So let's come back latest in 2028 and see what happened. Thank you all.